Hi, Michael. Thanks so much for joining us. I really appreciate you taking the time. So, Michael Kovacs, CEO of one of my favorite fund managers in Canada, Harvest Portfolio. So, Michael, if you wouldn't mind introducing yourself and just talk a little bit about Harvest in general as a fund manager, if you don't mind.
Certainly, and thanks, Adrian, for having us on. We really appreciate it.
Pleasure.
Harvest was launched late in 2009, so about 12 or so, almost 13 years ago. And we launched the company as an organization similar to what we do now, where we would be investing mainly in equities and generating income. And over the years, we started off in the closed-end business. We rolled a couple of those products into mutual funds, and then eventually, a little over 5 years ago, we got into the ETF market because you could see that area was growing very quickly. We believed in what we were doing. We felt it was a perfect fit for the ETF market, and we started to build out our ETF business at that point in time. So, long story short, Harvest is about long-term equity investing, whether that's just for pure growth or that's for growth with income. And it's very specifically set up that way because we're in a period of low interest rates.
Right.
We're in a period of a high amount of people that are retiring, that are planning retiring, and people are living longer. So all of these create a potential problem. And we believe, and even our name Harvest suggests that people have been building their assets, sowing their seeds, if you will, for decades. And here's a way to harvest those assets. And that was literally the genesis of the name Harvest, was to build products that people can actually generate and create income from. So that's sort of a quick story, but that's what we're about. And we've been consistent to that for 13 years.
Yeah, Harvest is all. I always talk about Harvest. They are one of my favorite fund managers in Canada, and just that logo on top of your head there, income happens here. I love it. As you know, my YouTube platform, my YouTube channel is all about maximizing passive income. So obviously, the bread and butter of my strategy are covered calls, or the covered call strategy. And Harvest is actually one of the biggest providers in Canada, fund managers for covered calls. So why did you guys decide to focus on these types of ETFs?
Well, that's a great question, because when we started our first couple of funds, as I was saying, we're focused on the Canadian market, and we're focused right after the financial crisis on where we could generate and capture a lot of dividend income. And at that point in time, our first fund, Harvest Banks and Buildings, there were some tremendous opportunities in the Canadian banking industry. You had yields in some cases of 9, 10, 11%. So in launching our first few funds, we could naturally capture high yields from a lot of the dividends and distributions that were being paid by banks and REITs and some of the large utilities and so on in Canada. As time went on and the market started to mature and come back, we had to find another way to develop an income strategy. And we started working with another firm at that time, not internally, that was a specialist in the option market. Realized that we could develop large cap, if you will, large company profiles, maintain our focus on being sort of a long-term equity holder, but we could write some options and generate that income. And it's interesting, Adrian, because if you go back 20 years ago, there were a number of funds launched where they were setting up funds that had up to 100% option writing. And what happened is, as markets started to pick up, or as markets declined, the big swings in markets, it eroded a lot of those portfolios down. So it's almost through trial and error, not some magical formula, but through trial and error, the industry came to the point where you could write, in our case, 25, 30, 33% max, generate that income, and still have that long bias without having that risk associated with markets making an extreme move higher or lower. I think I'm probably talking off topic here, but
no, not at all. I have plenty of questions regarding the covered calls. You're already starting to get into it, which is great. That's actually what I want to focus on. So, not a problem at all.
So that was really the basis of it. And then as we grew, we brought all of our investment management teams inside. We hired Paul McDonald. We brought in James Learmonth, and we've got 4 on the team, going to 5 shortly, and with a specific focus on long equity and option writing strategies. And we've become quite good at it, and we've been able to grow the business and grow our clientele over the years with people like yourself and your followers.
Yeah, you have great funds. I mean, some of your funds are very, very big, HHL being the biggest covered call one. I particularly love HHL. We'll talk about it later, but HHL is very cool and very good for us Canadians, because in Canadian portfolios, healthcare is very underrepresented usually. So I absolutely love the HHL fund. That's the first one I invested in. So going back to covered call ETFs, in general? You kind of touched on it already. In your own words, who would you say these types of ETFs are really designed for? What kind of investor would invest in a covered call ETF?
Well, first and foremost, people that are looking for income. And with covered calls, because you're using equities, you're trying to get some growth and generate that income. So income, whether that's pre-retirement, whether it's retired people, that's one big part of the focus. Another area where we see interest is individuals that want to have that exposure to the equity markets. But when you're writing covered calls, you're sort of writing away, to use that term, a little bit of the growth, a little bit of the upside. So here's a way to sort of lower the volatility slightly, yet still have that long exposure and at the same time generate that income. Some people reinvest that income. They don't want to take it out. They just reinvest it back into the fund. So if you're looking for a little lower volatility, maybe take a little bit of growth off the front to monetize it short term, or you're looking for income, those are the types of investors that we're finding that are buying our ETFs.
Yeah, you have a good point when you said that, you could just reinvest it if you don't need the income. One very versatile thing that I've discovered about the income strategy, or that I realize, is that you could still be an income investor and not need the income. You have the option to reinvest it. Whereas a growth investor kind of doesn't really have a second option. I mean, they make their money solely, usually just on capital appreciation. But an income investor, if you want the income, you take it. If you don't need it for now, or you want to reinvest it, you could always just drip it. So a very cool option. This is why I love the income strategy as a whole. So
another point is, it actually only happened this past weekend. I was talking to an individual who's just in the process of selling his business. Mm-hmm. And he's in his mid-50s, and he's saying, look, I'm not really looking for income, but I've selling my business. I've made all this capital. Where can I put it where I can sort of have a good long-term investment, but at the same time down the road generate enough cash flow for my needs? And I think we've got a perfect fit for him with some of our products.
Yeah, I agree. I talk to, a lot of my clients, they're doctors or they're dentists or people in the prime of their career. And they say, look, I really like the income strategy. I don't really need I love the cash flow, like you said, but I don't really need it until 10, 20 years from now. Well, I would just say, well, listen, just turn on the drip and it'll just max compound your growth. And then when you need it, you could just turn it off and start living it up and using the income. So very versatile. I love the strategy. So do you feel that covered calls, or the covered call strategy in general, is getting more and more popular with retail investors like myself and my audience? I feel like it is, but what's your take on that?
Well, you're right. It is getting more popular. And I was looking at some numbers before this call, and there's about 14 billion now in covered call strategies in Canada. Last year, that grew by 2.5 billion. So 20 odd percent was the growth rate last year. So you can see more and more individuals are looking at covered calls as a strategy for generating income. So the question is, yes, there's definitely growth there, and I think it's going to continue for some time.
Perfect. That's good news to hear. So in terms of which companies or stocks you choose for your ETFs, you touched on this before. You mentioned big cap, blue chip companies. So how do you guys choose your which stocks to put in your ETFs? How are they selected? Is there a specific screening method?
Well, that's a good question. For the ETFs, where we want to generate and have those option strategies, you need deep option markets. And in the United States, there's a lot of unbelievable amount of options trading on every single stock, different times, puts, calls, different spreads. So, and a lot of volume. So that's important, especially if you've got funds that are growing. You want to have that ability to sort of access that market and write without having to think about it. So, how do we develop the strategy? Well, the first thing we look at, and we want to talk about healthcare because you mentioned it, we're looking for industries that are growing at a very sort of long-term, have the winds in their sails, have great long-term growth dynamics behind them. And we see healthcare as an area, not just in North America or the Western world, but globally, that's getting bigger. So number one is, and I think this is the case in any investment strategy, choose the industry first. And if you're choosing the right industry, whether it's healthcare, tech, whatever that may be, that's half of your battle. So choose the industry that's growing. And in the case of healthcare, great growth industry. So number one. So number two, now we want to look for the largest sort of global players that have great track records of growth, good management teams, steady income track records from the standpoint of dividends, and have expanding franchises. Well, when we break that healthcare universe down, you go from about 5,000 stocks to about 70 or 80. Because we'll put into things like, well, does it trade on the U.S. market? Does it have options available? is there a minimum market cap of $10 billion? So you use all these macro factors to boil it down to your sort of 60 or 70 names. And at that point, then you get your pencil out, you put your cap on, and you start drilling down into the companies. Where are they invested? What kind of area of healthcare are they invested in? How do we diversify that portfolio? What are the growth rates? What kind of income can we generate on the options as well? So all that sort of gets you down to your 20 names, and then we allocate them across the portfolio. And listen, we're not in a static world. Things will change from time to time. We do take a name out and replace it with another name when we feel that's necessary.
I mention this to my audience often. A lot of people, they tend to always obsess, and we're going to talk about management fees a little later on, but they obsess over management fees on ETFs or funds, but they don't realize how much work and effort fund managers like yourself do to actually do the stock selection. So that was really the point with this question. So I wanted to know, what your process is for the stock selection. You got to choose the big companies, like you said, the ones that have long-term growth potential, the ones that have healthy options potential, which, as we know, the US market is really the biggest in terms of options. And a lot of your ETFs, like your biggest three, healthcare, tech, and the brands, they focus really on the US companies, right? So thanks for explaining all that. So, to my audience, yes, there's a management fee, but it prevents you, or it gives you the liberty of not having to choose and pick and choose your own stocks. Huge advantage. So now that we covered that, let's talk a little bit in detail about the covered call strategy. So as we know, covered calls, there's two really big important things. There's the coverage of the portfolio. You kind of touched on it earlier. So on how much of the percentage of the portfolio you're actually writing calls on, and the moneyness of the options. Are they out of the money, at the money? So what's Harvest's strategy when it comes to those two factors on your covered call ETFs?
Well, that's a great point. And I'm glad you brought up, because you touched on management fees, but we would say the majority of our management fee is earned on those option strategies. And there's some other managers that are out there where they'll just write a flat amount of options every month, 33% or whatever the number is. They'll write out of the money 2% or on the money, and it's literally just more systematic. What we do, and where we stay here, where we get our most brain damage, is when we're actually looking at all these elements you're talking about. So for continuing on the healthcare areas, since we were talking about it, I know last month we were written at 28%. And when you say 28%, there may be some names that have fallen quite a bit where we won't write options on those stocks, because we think there's going to be a rebound, a reversion. Yeah. Other stocks that have done very well, we might write a full 33% on those options, and we may write out of the money 2 or 3%. So there's a lot of complexities that are sort of going into that strategy. And I think I mentioned in our conversation before, on another conversation, that sometimes we'll write 110 to 150 contracts per month on a single fund. So we may have a position, let's say Johnson & Johnson, will write 15% on that stock. We'll see the stock move some more. We'll see the premium grow. We'll write another 5%. Maybe by the end of the month, we've written as much as 25%. So it's an ongoing process. And all we're trying to do is sort of figure out how much income do we need to generate over and above the dividend after expenses. What do we need to generate through our option strategy to pay that yield? Because we don't want to over-earn. We don't want to take away that long bias, as I talked about earlier, but we want to make sure that we're always earning enough to cover that distribution. And that's literally a process that we go through every single month at the end of the month as we're sort of planning for the next month. So there's a lot more that goes into it than people think. In the moneyness, you could have a fund or a stock that we're going to actually just sell the calls at the money. We may decide to sell out of the money 2 or 3% because there's still a little bit of upside on it. So all these variables go into into that sort of thought process, into our proprietary models, if you want to call it that, and we sort of spin through all that and have meetings every month and continuously sort of bring these things up. So it's a lot more complex than people may think sometimes.
That's for sure. And I try to explain it all the time. There's a lot that goes into writing covered calls. So you guys seem to have more of a dynamic, from what you're saying, you're looking at it every month. It's dynamic. It could be out of the money on names that are underperforming. You'll probably write less calls because there's more growth potential. So this is just another advantage besides the stock selection of having an ETF instead of selecting the stocks yourself for your portfolio, or actually writing the calls yourself, because it's pretty complicated. I've personally never I don't even have options trading enabled in my TD platform in my broker, but I do have some audience members that have done it, and they told me that it is tedious. It changes every month, and it's kind of like stock trading. So, for those of you watching, writing covered calls every month on a portfolio of stocks is not as easy as you think, because the market conditions change all the time, and there's a lot of things to look into. So thanks for that explanation. I really appreciate it. Kind of touches. Oh, sorry. Go ahead.
And I'll leave it at this. But there's been periods of time
Yeah.
where we've seen, say, healthcare is undervalued. We think it's going to run for possibly 2 or 3 months. We'll specifically underwrite. So we may write only at 15, 18% as opposed to 25 or 30, because we think there's much more upside in that portfolio to generate capital gains. So all of these things are going into that process for all of our funds that with the covered call option strategy.
Yeah. It's a balance, right? I mean, you guys are trying to capture as much growth as possible with the richest income as possible. So it takes a lot of work. Like you said, you guys rack your brain about it every month. And honestly, that's what I would want to hear from my fund manager, right? You don't want, some fund managers have covered call strategies that are set in stone. That could be okay too. But obviously, the more work fund manager puts in, probably the more total return you get. So this brings me into the next question. Harvest seems to have very, very, and this is one of the reasons I love you guys, stable and consistent monthly distributions. I mean, HHL, for example, the distribution has never changed in, I don't know, since inception. HUTL is the same thing. You have your brands one and the tech one, covered call ETFs that have had some distribution increases. I know HTA, the tech one, there's another increase coming this month. So what's your policy regarding monthly distributions? Is that verified or decided once a month, or kind of like you said, you try to have the same distribution every month?
Well, we have an annual distribution policy. So we set the distribution. We just went through this a month or so ago. We'll set the distribution for the year. So we'll look at, say, on HHL, 70 cents or 5.83 cents per month. We will look at that. We'll look at the portfolio, how much income we're able to generate, what's the yields currently on the portfolio. Can we maintain that 70 cents? Do we feel comfortable with it? Yes. And we'll lock that in for the next year. And it's very rarely going to change. Sometimes you'll see, like you mentioned, HTA, we'll increase the dividend. In that case, we found that the tech market was running quite a bit over the last couple of years, moving up higher. The yields on the stocks were coming down, but the volatility levels, if you will, were getting higher, and we found that we were writing less and less to meet the income requirement.
Okay.
So what we realized is, geez, we're only writing at about 13%. We could actually increase the amount of writing we're doing and generate more income. So that's why we increased that dividend. So if we see opportunities to increase, we will. The counter to that is with our energy fund. When energy a couple of years ago was really getting pounded, and I'm sure many remember pre-COVID, you had, I think, at one point their energy prices went negative for a while.
Yeah.
Companies were cutting their dividends, option writing, the option volatility had dropped off. We had to reduce that distribution. And it was only after months and months of sort of painfully sort of going through that decision-making process that we decided to cut the distribution. So distributions can be cut. That did happen, but we've since actually increased it again since the markets have been coming back and energy's been coming back. But that's a much more volatile area. But the idea is, for tech, for healthcare, for global brands, for utilities, and so on, it's much easier to sort of set that number and stick with it.
Yeah.
So it's an annual process. Long story short, it's an annual process.
Okay, cool. Yeah, so I put a lot of time and effort into it, and yeah, I have seen that your energy one, you had reduced it, but now you raise it from a penny to a penny and a half. So a nice big increase there. Like you said, you make the decisions once a year depending on volatility in the market. So that's good. So we kind of touched on this, but I'll ask you the question anyway. My audience members, in case you didn't know, I'm not affiliated with any one fund manager, so I like to ask the hard questions. So here's a fairly hard one here for you. Harvest, the management fees. Your management fees are slightly higher than, let's say, other covered call providers like CI or BMO. So HHL, HTA, they have 85.85, so 85 basis points, whereas BMO will have 65 basis points. So is that because of you have a more, like you touched on, a dynamic strategy when it comes to your covered calls?
Well, basically, yeah. I mean, we do a lot of work. We actually feel that 75 beeps or 85 beeps is good value for what we do. We also have some funds that are 40 basis points. So if you look at our overall fund perspective, we have some at 40, some at 50, 65 to 85.
Yeah.
I think our median rates are around 60 basis points. So overall, we don't really feel that we're that out of the ballpark, if you will. We think we're actually quite in the ballpark for what we do as an active manager. If we're more, let's put together a portfolio that's more indexed, and maybe we're working with an index manager, we'll set up a fund at 40 basis points. But we think 30, 35 basis points of those more expensive funds is the option writing element.
Right.
And that's how we sort of valued that to get to that number.
Yeah, no, and I completely agree with your assessment. I always say the same thing to my audience members. For me, worth every penny, because number one, the income, the covered call income is all net of fees anyway. And number two, like you said, it takes a lot of work to do. And either way, I mean, most people who are with financial institutions, they're with mutual funds. We're talking about 2.5%. There's not even any covered calls there. They have a lot of active management, but these ETFs, even though they're less than half. So in my opinion, well worth it. So thanks for clearing that up there.
Happy to.
So, okay, I'm very excited about this. You guys just announced a new fund, an all-in-one ETF kind of HDIF, HDIF. So in there, it's going to have 5, correct me if I'm wrong here, I think it's going to be equal weight, 5 out of your 7 existing covered call ETFs. So the healthcare one, HHL, the tech one, the brands one, which is the best brands in the world like Apple, Microsoft, etc. The US banks one, and your utilities and telecom one. So talk to me about this fund. What made you come up with it? And also, you said you're going to have some leverage on it, up to 33% leverage. So what's the yield target? Tell me all about this fund. Very excited about it.
Okay, well, this has been in the can, if you will, for a while. We've been bouncing this idea back and forth for the better part of 2 years. But we're having a lot of growth and having a lot of success with our existing products. We decided that it's almost like a best of, if you will,
right.
of Harvest. So this way you've got some healthcare, you've got some utilities, you've got some of the brands. You end up with about 90 or so companies, if you want to sort of break it down across that portfolio. And then when you combine those yields, and we could go up to 33% leverage, but we're going to probably be around 25%, which is moderate and considered moderate to low risk. We'd rather keep the risk down, but it helps us to increase that yield to, right now, it looks like it's going to be about 8.5%. The yield on that fund. So we're not launched yet. I think we're a couple of weeks away still, at least at the time of this recording. And we're getting a lot of excitement about it here. We put together some great sort of pieces of marketing on it that everyone will be able to see shortly. But you can say it's sort of the best of the best. Let's take our strategies, let's equal weight them. So yes, you're right. So 20% across each of the 5. And let's put together a sort of diversified basket of top companies or our top ETFs and generate that really nice enhanced yield.
Yeah, I like it. I mean, as you know, Hamilton ETFs just came out with one 6 months ago. HDIV, very successful. I've been talking about it, and you guys just announced one. And I know for a fact that other ETF providers are coming out with more of these. So these seem to be very popular. Like we were discussing before, this just proves that the covered call strategy is more and more popular. And I love the fact, my favorite part about this is that, like you said, these are all-in-one funds. They're already diversified within each other, within the fund itself. Plus you got that leverage for that nice enhanced yield, 8.5%. So really cool. So you put the 5, but you left out the energy one and the real estate one. How come those weren't added in the new fund?
Well, I talked a little bit about energy earlier. Energy is very volatile, and that yield is not as locked in, as, if you will, as the other ones. So we were a little bit hesitant to put energy in that portfolio just because of the volatility and the aggressiveness, if you will, of that particular portfolio. Global REIT is in the universe. So at some point in time, you might see utilities come out, or you might see the banks come out, you might see global REIT go in. So it's always there. It's in the basket. And in our prospectus, we say we can move to another Harvest written covered call fund if we want to.
Oh, okay, cool. So it's not set in stone.
Yeah. So we do have the ability. It's not set in stone. So we do have the ability to make changes. If changes are made, we would announce it ahead of time, but they'll be rare. But we do have the ability. Let's say we have a fantastic run in banks, and we feel that there's a better opportunity to be in the global REITs. We might take the banks at that time and put in the global REITs fund. But overall, we don't want to be changing that yield. We want to keep that steady and consistent as long as we can.
Yeah, I
Again,
love
that'll
that.
be set for the year, and we'll continue to keep that going right through for the next year.
I love what you just said. We might, if the banks have a run, we might switch it for global. So this is just, I'm talking to my audience here, professional management, hands off, guys, passive income investing, what my channel is all about. I love these funds because you're paying the management fee, but it's worth every penny, in my opinion, because you have professionals looking every month, seeing what changes could be made. So thanks, Michael. I appreciate that. For you getting into that.
It's important to say also, you talk about the management fee. So the underlying, the 5 funds, they all have their management fee. And
right.
the overlying fund, HDIF, will not have a management fee. So it's basically, there's zero cost on that top fund. It just owns the funds below it.
I'm always excited. I'm always on the lookout for new covered call funds. You have 7 of them. You got the new all-in-one coming out. Besides that new one, are there any plans for any new covered call ETFs in the future?
Well, we're in a regulated business, so I can't really talk about it. But the thing is, we do have sort of plans in place to possibly launch a Canadian covered call product later this year. But again, it's still sort of in the works, and we're bringing out HDIF, as you know. So that's sort of keeping us occupied right now. But there is another one that we could be looking at bringing out as well this year.
That actually brings me to my next question, which is Harvest seems to be really focused on American companies and not Canadian companies. My question originally is, why is that? Is that because of the options market? Is it more mature and lucrative in the US versus the Canadian market?
Well, definitely bigger and deeper markets in the US, globally as well. We do have some Australian stocks and European stocks and stocks that trade on the FTSE in London as well. But in Canada, it's a little more tricky around the option writing. So we would
heard that.
So we would have to, the markets aren't as deep. There's more players or less players involved. So we would have to do some sort of pre-structuring for that type of product in Canada. But it can be done. It's just a little more complicated. But we are looking at that. But from the standpoint of overall, we actually started, I mentioned our Banks and Buildings, our first fund is a Canadian fund. Our Canadian Income and Growth Fund, these are 2 sort of small but long-running mutual funds we've had. They're Canadian.
Right, I was going to say those are mutual funds, right?
Yeah, so we did start off actually with a Canadian bias, but as time went on and we started looking at other ways to generate income, U.S. stocks provided a lot of opportunities.
Okay, cool. All right, so now I want to get into the split share funds because I'm very excited to talk to you because it's the first time I'm talking to a fund manager that actually manages a split fund. I've been trying to get interviews with split fund managers. They're lesser known funds. They're more complicated. People run scared of them. I actually love them. So you guys do have one. You have PRM, right?
Yes.
It's a split fund on healthcare, which
Big pharma. Yeah.
Big pharma, yeah, and it has 10 stocks in it, opposed to HHL, which has 20. So in your own words, I know it's sometimes it's hard to explain to a regular person. I've had difficulty explaining it and understanding it myself. So how does a split share fund work, and for who is it designed for?
Okay, well, it's basically, you have, in the case of Big Pharma, you have the 10 largest by market cap pharmaceutical companies in the world, and many of those names are in healthcare leaders. So what we do is you put together that portfolio, and then technically what you have is one share, and that share is $25. So you price the portfolio based on the portfolio you're building, in this case, Big Pharma, with one $25 share. But then what you do is you split that share. So you have a $10 share, and that $10 share is your preferred share. So like on any preferred, you usually have a set yield.
Yield.
Yeah, it's 5%. And that yield is completely protected by the whole $25 portfolio. You understand what I mean? So that preferred, that 5% must be paid regardless of what happens out there. Everything is about protecting that 5%, if you will. So what happens is you get a rating on that. We have a DBRS rating on that fund, and it trades like a preferred, and it's actually trading around 1050, I think, or so in the market. But there's a big market for preferred shares, and a lot of people like that side of the split share, if you will.
Very stable, right? Very consistent. Yeah. The stock price usually never changes.
Yeah. So you've got your preferred share. Then the other side of the split, the $15 portion, that's a capital share. So all the yield that's being earned that doesn't have to be paid out to the preferred goes to the A share. And in this case, I think it's about 9% that A share is paying right now. So you get all the growth of the $25. So you get the $25 worth of growth focused into just that $15 unit, because the $10 unit, the preferred share, never changes price. It's always $10. That's the NAV forever. It's set there.
Right.
And like I said, everything's about protecting that $10 unit with the 5% yield. All the extra growth, all the extra yield goes to the A shares. So what happens is you have a lot of investors that find those very attractive because they get a higher yield, they get a little bit more risk, if you will, from the standpoint of a little more leverage on that fund. And if you like healthcare, which we do, it's a great product. It's a great share to have as well. So the reason why it's called split is because you're really taking a $25 unit and splitting it into these two. So I think I may have.
I think that was great. Honestly, I couldn't have done it better myself. I think I made a video and it took me an hour to get through it, and you just did it in a few minutes. So pretty good. I would definitely fall into the category that loves the Class A. And correct me if I'm wrong here. The typical way I explain it to everyday people, or that kind of know what covered calls is it's basically a covered call ETF with leverage. So I say like there's a bit of steroids in there. So you have the covered calls, the yield, that all, the capital growth, like you said, it all goes to the Class A shares on a leverage basis. So how do I explain, or how can you explain how the leverage works with these split funds? Because it's really the leverage based on the preferred shares, right? How does that work?
Well, it's the leverage based on the whole, it's all the growth over and above the $25 goes to the $15 unit. And really, that's the simplest way to explain it. So if that overall unit goes to $30 over a 5-year period, actually your $15 unit will go to $20. Your $10 unit will always stay $10.
Okay, so that's where the leverage.
Your leverage is on the overall. You're getting the growth, whatever that works out to, and you're getting 75% leverage or whatever that number is. So you're getting $25 worth of leverage on a $15 unit.
Okay, so it's not classic leverage like with your new fund coming out where you borrow money, right? It's not that kind of leverage. It's just built into the fund itself.
You're getting leverage on the whole unit value.
Okay.
But you're saying there's some people that love that. They want to own the capital shares. And there's other people that they just want to have a preferred share in their portfolio and they can sleep at night and they just leave that there.
Right. It'll always stay at $10. No matter what the market does, you'll get your 5% and that's it, right? So I'm more of a big fan on the Class A shares. I'm okay with taking a little bit more risk. So, but I guess to each its own. I guess the preferred shares have their place in a more lower risk portfolio. Any plans for a new split share besides this one?
Not at this time. We don't. But it's a structured product. It's a closed-end fund, if you will. So there's a lot of costs involved in launching those funds. So. And you have to, it's almost like an IPO. It's like a new issue. So you have to feel confident that you can raise money in that offering, and you have to raise the exact same amount of money in the preferred as you do in the cap share. And what happens a lot of times with those type of offerings is everybody wants the preferred share, and then you have no one buying the capital share. So it's a little more difficult, a little more complicated to raise money in. But if we can at some point, we will. But right now, there's no plans to launch another one.
Okay, fair enough. Thanks for that. I appreciate that conversation on the split share funds. I love split share funds. They're like, they're very hard to explain, but I think they have a good place in any income portfolio or a low risk portfolio, really, if you want to get those preferred shares. So moving on to, even though I focus only on income, you guys do have a nice suite of growth oriented ETFs. And I wouldn't do you justice without mentioning them, because I find that you do have very interesting emerging market and niche ETFs. So you have a couple of growth ETFs. Like you mentioned before, they typically have lower management fees because they're based on indexes. You have a blockchain one, which I found very interesting, green energy one, a space innovation, and you just recently introduced a new one, sports and entertainment. So give me your mindset between on creating these growth oriented ETFs.
First of all, I own all of them because I'm excited about the growth of all of these categories. Going back to just a quick step back to the Harvest philosophy, it's about we only want to own industries that are growing, like growth industries that have tailwinds in their sort of sales, if you will, and sort of mega trends that are sort of morphing and growing out there. We don't want to see ourselves as being thematic. We really want to focus on growth themes. And a lot of that might go back to my own sort of early days in my career. I was fortunate enough to sort of come across Warren Buffett and study Warren Buffett, and really sort of early in my career became indoctrinated in the idea that own great companies, own strong growing industries, and stay with them for the long term.
Right.
So in the case of the growth portfolios, whether it's a blockchain, which is one of the fastest growing digital secure technologies out there right now. I mean, all cryptocurrencies are based on the blockchain technology. They wouldn't exist otherwise. The NFTs, all these things you're hearing about, um, deregulated finance, mobile finance on your phone, all of these technologies must use digitally secure, more than encrypted type of security, and blockchain provides this. And without getting into a whole explanation of what blockchain is, it's growing. You probably are using it more than you know in your day-to-day life, and it's only going to get bigger. So in launching that fund, we wanted, and it was the first one in Canada, we wanted to focus on the companies that we saw having the greatest upside in the blockchain sphere, the sort of true blockchain companies, and stick with them over the long term. So initially, we had a lot of larger companies in there, like say an IBM that had a blockchain platform. As the emerging blockchain sector matures, more that becomes a larger and larger part of the portfolio. So it is an index, but it's almost like an evolving index, the way it's been developed. And that just goes back to, if anyone remembers, like 1999, 2000, 2001, the tech wreck. A lot of great companies, or what you thought were great companies, got destroyed.
Right.
And a whole lot of new companies emerged. So we wanted to make sure we didn't get caught in the same situation. We wanted to make sure we could launch a product that could evolve as the industry evolves, because there may be companies in that portfolio 2 years from now that don't exist today, and that will be huge 20 years from now. So it's a long-term positioning in an exciting growth technology. Green, same idea. I mean, green stocks have had a hard time this year. Green energy.
They have, yeah.
It was a very hot sector 2020. Yeah, 2021, it's been clobbered. We just had a discussion on it yesterday, our investment management team, and said, we love it. We think that the upside is there. It's not going away. Governments, corporations are completely committed to this. The consumer is committed to the space. So we're going to sort of stay behind that and look for opportunities and let that fund grow over time. Actually, blockchain when it out was down about 40, 50%. Now it's one of our top performing funds. So when you're into these growth areas, you're going to have that more volatility. Longer term upside is much greater. Yeah. Travel, the same thing. Travel was a big success for us last year, and it came out of the gate. It rallied up 25, 30% very quickly, rolled back, but at the end of the day, it's an industry that's growing faster than the sort of returns on it were higher than the S&P 500, and this is before the pandemic. It got, again, a lot of these stocks were down 70, 80%. We know the travel industry is going to come back sooner or later. We want to be positioned across the 4 or 5 categories to capture that growth over the long term. So you're sort of hearing the same theme over and over again. It's like we either have growth with income or we just have growth portfolios.
Yeah, and I think that's very smart. You're tailoring to both types of investors. I usually say the same thing. I say, whether you're investing for growth or income, long term, if you're investing in, like you keep mentioning, good sustainable companies, you'll make your money either way. You're just making the return differently, one with capital appreciation and one with the consistent passive income. So yeah, I really like your growth oriented funds. I think they're very smart. They capitalize on what's going on in the present world, right? The travel one, you even have a space one. So really, really cool stuff. So congratulations on all your success, on Harvest success. I kept you for a long time.
Oh, that was great.
I don't want to keep you further. And listen, I really appreciate it. I love the Harvest ETF lineup. Hopefully we get more funds. And listen, come on anytime on the channel. When you have a new fund, you're welcome to anytime. So I'll let you get the last word if ever you want to add anything before we drop off here.
Sure. Well, the one thing I want to say is thank you, Adrian, for having us on. But also one thing about Harvest is my philosophy is I'd rather be narrow and deep than shallow and wide. I'd rather really focus on what we do and do it well. I don't think you'll ever see Harvest have 100 different products. We have 15, and that's, maybe there'll be 18 at some point, or maybe there'll be 14, but we'd rather be really focused and just do that and be known for doing that and providing that to our clients, to your clients.
Yeah, no, it makes perfect sense. I kind of hear Warren Buffett there, right? That's his attitude. He always says, it's crazy to own 30 stocks or 50 stocks. I'd rather own just 10 or 5 of the best ones. So I agree with that. I think you guys have a really nice lineup. And again, congrats on the success. And hopefully we talk again soon. Thanks, Michael. Appreciate it.
Thank you. Take care. Bye-bye.
Thanks for watching, everyone. I hope you enjoyed that fund manager interview. I have a lot more coming up in the future, so make sure to stay tuned. Please show your appreciation. Hit that like button, hit that thumbs up button. I would really appreciate it. It takes 2 seconds and it helps the channel grow. So it's a win-win. Also, since I have a lot more great content, including fund manager interviews coming up, make sure you're subscribed to my channel if not already done, and hit that little bell next to the subscribe button so you're notified when a new video comes out. You don't want to miss it. And don't forget to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product that I'm very proud of, the ultimate DIY investing package, which is on version 3 right now. You only have to buy it once because it comes with lifetime updates. Don't forget that. So this product is really a reference tool, a companion tool to really help you build your own portfolio according to your investing goals and needs. And it's good for Canadians and Americans as well. You have sample portfolios for both the Canadian stock market, the American stock market, and my intention is really to do at least at the bare bone minimum an annual update. So make sure to pick it up because it comes with lifetime updates. Also on my website, right there on the homepage, I do offer a one-on-one consultation service with me personally. It's a 1-hour Zoom call. In case you want more personalized help here, you could ask me all the questions you want. You could, I'll help you, I'll analyze the situation, help you build a brand new portfolio, help you transition to an income-focused portfolio, analyze your portfolio according to your needs. Whatever you want me to do, whatever help you need, I am there to help you. I absolutely love meeting people all around the world and doing these one-on-one sessions, but I gotta limit myself to 4 a week because I need the time to create obviously more YouTube content. So I know they sell out very, very quickly. I get emails all the time from you guys saying, you know, can you put me in? Can you put me in? I always miss the appointment. I apologize for that. There is a high demand for the one-on-one consultation. So like I said, I got to limit myself to 4 a week, but make sure you're subscribed and make sure to join our Facebook group because I make the announcement whenever the calendar becomes available or the new appointments open via YouTube, community post, and via Facebook. So join our Facebook group, Passive Income Investing. We have a nice Facebook group, almost 10,000 members. It's a nice group where everyone just puts their questions and we all try to help each other out. You could put your portfolio to get opinions. So don't be shy. Join our Facebook group and join us there to really share in the knowledge sharing, right? It's a great group. We're also on Instagram. If ever you want to know more about our personal day-to-day life, you could follow us on that social media platform if you use it. My mission, the mission of this channel will always be the same. It's to help everyday, normal, regular people to invest on their own, to build their own stream of passive income, to enhance their quality of life, and one day become financially independent. There's no greater feeling in the world than financial independence. Trust me. So continue to stay safe, everyone. Stay healthy, and of course, stay passive. See you next time.